Welcome. On today's episode, we're going to be talking about end-of-year tax planning. I'm Abraham Berkemeyer,
And I'm Tyler Hafford.
and this is Financial Discretion Advised.
Awesome. Thanks, everyone, for joining us again. Today is, like Abraham said, end-of-year tax planning. But before we get started, we want to remind anyone who's listening to us, check us out on YouTube. We're doing videos now. If you think Abraham and I are awesome in just audio, you should see us in video. Anything that you're finding us on, any podcast catcher, YouTube, like us, subscribe. All that helps. Please write some reviews or leave some comments. We'd like to see what everyone's thinking. But Abraham, why don't you get us started?
Yeah, I think one of the main things that comes around this year for anybody of older age is generally required minimum distributions. I think we should give everybody a little tax update on that because that's a big one that you need to take care of before December 31st every year, except for this year because we got some changes.
Yeah, a little bit of change, but like you said, big tax bite there if you miss these. And this is something, especially folks who have never taken a required minimum distribution or RMD in their life, right?
Yeah.
And it's just something you're not thinking about if you've never heard it, but it is a 50% tax on the money you're supposed to take out of any retirement account if you're not taking care of that by December 31st.
Yeah,
So,
well, we should qualify that any pre-tax retirement account.
thank you. And we'll get into a little bit of the difference between those two a little later on in the
Yeah.
show. But yeah, absolutely something to be paying attention to. And up to this point, it has been, if you are 70 and a half, you got to take out your required minimum distribution, but that's changed recently, and we've upped that to 72.
Yep.
So if you were sweating it this year and you were 69, you got a few more years before you got to start taking them out. But certainly something to pay attention to.
Yeah, and for those of you who are required to take RMDs because you were over that age 70 and a half threshold in the past, which used to be the old beginning date for required minimum distributions, now that is age 72.
Yep.
So, that might have been, this year would have been a year that some people probably would have thought they had to take an RMD, got pushed out. But whether or not you thought you had to take an RMD or you're already past that age and had started RMDs, the CARES Act is one of those things that happened this year due to the coronavirus, where the United States government has said that required minimum distributions are not required this year.
Yeah.
So if you were sweating it and trying to think of, I got to call up my financial advisor and get that RMD taken care of this year.
Yeah.
There's a reason that you don't have to, and it's the CARES Act.
Yeah.
So, that's pretty good. It doesn't just have to be anybody who has over the age limit for RMDs, but that also qualifies for inherited IRAs where you might have had to take an RMD for this year if you were on a life expectancy method. But that is also not required for 2020.
Yeah, and I think it's good that you brought up the inherited IRAs as well, that you're not required to be taking any money out. For folks listening wondering why Abraham and I are positioning this in the fashion of not wanting to take money out of your retirement accounts, is any of those qualified retirement accounts are going to come with a tax hit when you're pulling money out of them. So in a year, you don't need to take any money out of them. It is more beneficial for you just let them sit in there and stay invested. So if you don't need to take any money out of those accounts and the government is giving you this pass because coronavirus showed up, definitely take advantage of that. It can be a good kind of planning tool for you that you just kind of got a year of, all right, well, I didn't have to take anything out. I don't have to pay extra taxes.
Yeah, that's one of those big things with required minimum distributions. The government says once you're over that age, now age 72, you have to start taking money out of this. We gave you a tax deduction while you were working.
Yep.
We're going to get some tax money on this eventually. So
Uncle Sam is always going to come to get his cut. And, he's giving you the tax break, back when you made those contributions, but he wants his share.
Yeah.
And that's what the required minimum distributions are, is kind of saying, all right, we got to get taxation out of this. But there are some ways to avoid taxation out of your RMDs or your retirement accounts. And that's done by qualified charitable distributions.
Yeah.
Right.
So if RMDs weren't confusing enough, now we got QCDs. And if you any given year, say you don't need that RMD and you have in your of a charitable mind and you want to give to charities, you can actually give up your RMD or a portion of your RMD to a qualified charity. The IRS has a nice little search tool. You can go on and find all the qualifying charities. So if you Google it, you can find that search tool real quick on the IRS's webpage and say, hey, want to give a portion of my RMD to this company or this nonprofit. And
we should have named this podcast the ABCs of end of year tax planning, but
we still have time. We haven't named it yet. It's not live.
But like Abram's saying, if you're someone who does do charitable distribution or charitable contributions anyway in a year, be a good way to avoid some taxation on money you were going to have to take out. Anyway.
Yeah. So that QCD, however much you give away, it doesn't even flow through to your tax return.
Right.
You don't have to claim that as income like you do a normal required minimum distribution. So
and in the realm of charitable giving, the CARES Act actually made some changes to that as well this year, just for folks who are thinking of, all right, what are my tax deductions going to be on just kind of what I'm contributing this year. And Abram, why don't you kind of walk us through where we were prior to the CARES Act, what this year will look like, and how can we maximize that?
Sure. So there were really two big things that came out of the CARES Act. Yeah, it came out of the CARES Act while you were, and when it comes to charitable giving, and one of those was the increase in the AGI limit for anybody who's itemizing their deductions. So typically when you're taking a charitable contribution, you can only do so when you itemize your deductions.
Right.
There's a little bit of a caveat this year, which we'll talk about.
Which has gotten more difficult with recent tax law changes, right? So they essentially brought up the standard deduction, and what that was doing is encouraging folks or making it more difficult for them to itemize. And it created, in their mind, or in some folks' mind, a simpler tax system, right? That we don't have all these itemizations. What it did is actually made it more difficult for folks to get above that standard deduction with things like charitable.
Right, and the reason that's important is if you're not getting above that standard deduction with your itemized deductions, then you're not going to take the lower itemized deduction because people don't pay more in taxes than they have to.
Right.
And so you take the higher standard deduction and you don't itemize in that year. So this year, if you are itemizing deductions, you can now, in the past, for charitable contributions, which is one of the things that you can itemize. It used to be that you would max out as how much you can give to charity as far as a tax advantage at 60% of your adjusted gross income for that given year. So say your adjusted gross income was $100,000, 60% of that you could, if you gave $60,000 to a charity in cash, public charity.
I'm proud of your quick math.
I know. I was like, I was thinking, oh, well, if I use $60,000, that's going to be really hard to calculate 60% of. So I'll really go with a nice even 100. So in that case, you would only you'd only be able to itemize 60,000 out of that 100,000.
Right.
This year, if you're charitably inclined and you don't need the income, you can actually itemize up to 100% of your AGI. That might be obviously pretty hard to hit for a lot of people given the current economic environment, but for those who are charitably inclined and don't necessarily need the income and want a good year to be able to give more, it's a very good option for them.
Yeah, and I think that's kind of what it is. It's if you were giving up to 60% originally, arguably you had some room there to go up, and this is just giving you a little bit more of a runway there if you were looking to give some money away.
Yeah, the one that it's probably hits more homes and is more applicable to almost everybody in the United States is that they actually have another charitable deduction that you can take even if you take the standard deduction. So now we're not picking and choosing between the itemizing and the standard deduction, but it is a much smaller deduction. So this year, if you do take the standard deduction and you give to charity, you can take an additional $300 off the top of your standard deduction, add that for charitable contributions and deduct that. So, if you're not deducting your whole salary, you take the 300 and you're able to give to charity and get some tax benefit out of it.
And really, really nice thing for people to be able to itemize in this year, because arguably there is a lot to give your money to if you have the ability to do so. All right, there's a lot of coronavirus focused charity groups out there. You may be able to help quite a bit of people, and if you have that capability, this is just another nice tax incentive to say, all right, take your standard deduction, but cut a little bit off the income there if you want to make a contribution. So, kind of moving away from that and into, all right, how else can we lower our taxable income in every year? Is using things outside of a work plan, like a traditional IRA, or maybe you're a single business owner, you have a SEP IRA plan. Great ways to kind of chop some money off of that adjusted gross income. And a lot of times I have clients who come in and they say, I just have a lump sum. Now, these aren't decisions you have to make by December 31st, like the RMDs. These are things you can do until tax time. But hey, I have some, an extra five grand here. I want to put it away and get some tax deferral on that. Using an IRA is a great way to do that. But talk to that strategy, and using a SEP, you even have a larger runway there.
Yeah, definitely. So with retirement plan contributions, I think you hit the nail on the head in the beginning. Like you said, they're incredibly flexible because you don't have to get it done by December 31st. Right. You don't have to be on a routine payment plan. If you are eligible to contribute to a traditional IRA by the tax deadline, you could contribute it the day before the tax deadline and get all that money in there and get it invested and get the tax deduction on your tax return.
Anyone working with an accountant has probably had this conversation as we've got to the end of it. But even, if you're doing TurboTax on your own, TurboTax will even prompt you, hey, do you want to make a contribution to an IRA this year and lower that taxable income? So it can be a great way to shelter a little bit of money off for retirement and get kind of tax break today.
Yeah, and especially for self-employed individuals, like you mentioned, the SEP IRA. So that's an employer-based plan, and if you're self-employed, then you are your own employer, and you can contribute up to that account. Depending on how much you make, it could be more than you could contribute to a traditional IRA. So it's a really good way to get some tax deferral. And once again, you don't have to get it done by December 31st. You got until April 15th, so you can coordinate with your tax.
And this year the SEP can be really powerful. It's up to 25% of your compensation that you're making as your own business owner, or $57,000, whichever ends up being the higher of those two, the lesser of those two. So if you have your own business, you're only employee. And Aber and I will have some future podcasts surrounding tools for retirement plans for businesses, because these can be very difficult. But if you are just a single business owner without any employees, using that SEP, you can leverage quite a bit at the end of the year, especially right around tax time to change your entire tax picture. So that's great. I have a conversation with my clients quite a bit who have some money at the end of the year, where we have this conversation surrounding, all right, do we want to get a tax deduction today and make a contribution to a traditional IRA? Or do we not really need that tax reduction today? And do we leverage a Roth IRA? Which anyone listening, the difference between that is, an IRA, you put money in today, you get a tax deduction, it gets tax deferred down the road. In retirement, you take it out and you pay your taxes then. A Roth is working in the exact opposite. You're going to pay your taxes on your contributions today, ride it out through retirement. Anything earned in there is going to come out tax-free, which can be a powerful tool for a couple of reasons. Tax-free growth is fantastic. It also allows you to diversify your tax picture in retirement. Those RMDs that we were talking about at the beginning of the show are required on that traditional IRA, not required on the Roth. So it allows you to put some money away that the government's not going to force taxation on you down the road.
And if you have legacy planning goals, Roth IRA passes down to heirs, also tax-free. So that tax-free growth, that could be a really long time horizon, and that compounding interest is going to add up.
But certainly a conversation to be having, one, with your financial advisor and your accountant. If you have some money and you're thinking of an IRA, do I need the tax break today, or can I leverage something that might give me some advantages down the road?
And I think the other big thing there is that a little outside of the scope of this podcast, and definitely ask your tax professional. But there are lower limits if you have, or for traditional IRAs, for how much income you can have as a household.
Yep.
Depending on if you have a retirement plan through work. So if your household is, pretty good income earners and you have retirement plans through work, you might actually get disqualified to take a traditional IRA contribution. But definitely ask about those limits with your tax professional, and just in general, the Roth IRA is a higher limit where you can contribute.
And there are some strategies around that, right? So even if you are kind of bumping above that income bracket, there still may be ways of utilizing a Roth IRA. Using what's called a backdoor Roth conversion or Roth conversions. And I'm going to let Abram kind of walk us through that because he's certainly well versed in this. But it can be a way to say, all right, how do we have money that's in the IRA today, but I want to convert it and get that tax-free growth down the road? Is that possible? Or am I locked into this kind of traditional IRA tax deferral bucket for
Sure.
ever, right?
Yeah. And these Roth conversion strategies generally aren't necessarily for folks that are in their working years, unless you've got a year of lower income. Then it might be a good strategy for you. But if you're in your prime earning years, typically it's going to be something that we might table off closer towards retirement, when maybe you're working part-time or half-time, or you have an early retirement and you don't have any fixed income coming in yet.
We want that tax bracket
coming
down.
Yeah, your tax bracket's hitting the floor, and now you're like, okay, great. I can either pay nothing in taxes, or I can maybe decide to pay the government.
Yeah, and to back up a little bit on that Roth conversion. So what functionally what is happening is that we're taking money out of the IRA, paying taxes on that distribution today.
Right, and you're choosing to.
And the idea is that we have more control over our circumstances at this point to make this decision.
Right. Depending on how much you take out of that IRA,
right,
it's going to depend on where you are in the tax bracket.
And we're not just taking that and we're shoving it into our bank account and hitting the Cayman Islands. What we're doing
maybe you're not.
Well, no, I'm using your bank account for that. We are shifting it and moving it into a Roth IRA.
Yeah.
And essentially now we're starting tax-free growth from here on out. Definitely a conversation to have with your financial advisor and your accountant. Also, Roth conversions can be advantageous in market dips. If you see extreme market dips, it's kind of like what we saw in March, might be a good time to start converting because your tax burden is going to be a little bit smaller if your account's down 20%, right? It could be that silver lining of taking advantage of some opportunities there.
Yeah. And I think the next big conversation with end of year tax planning, when we're talking about opportunities, is tax loss and gain harvesting.
Yes.
So, us as investment managers in our firm.
Thank you, Sam.
Thank you, Sam. Shout out to Batman. His part of our job is tax loss and gain harvesting throughout the year for any of our clients with taxable accounts. And just so anybody knows, a taxable account is an account that's funded with after-tax dollars, but you don't get preferential tax treatment like you do in a Roth IRA. Instead, you have to pay income taxes on any income earned throughout the year,
right,
and you have to pay capital gains taxes on your investments when you sell them on any gain that you have in those positions. But capital gains taxes can also be offset with capital losses.
Yeah.
So you can lower your tax liability throughout the year when, if you've held on to a legacy position in a long time for a portfolio and the market tanks, you can now move out of that position into something similar. So say you've got a company with, 500 large U.S. companies in it.
Yep.
And that's the fund that you own. And then you could sell that and purchase another fund that's pretty similar to that.
Yep.
So that way your portfolio is staying in the same risk profile, but you're able to offload a fund you didn't necessarily want and not have to deal with the gains.
Yeah, it can be, like you said, real powerful. If you're working with a financial advisor, ask them about the tax loss harvesting. Make sure tax loss and gain harvesting. Make sure that it's happening, right? That you're taking advantage of it. If you're one of the folks listening to us and you do it yourself, two really big things to be paying attention to that I think get lost in that do-it-yourself model is proper rebalancing to make sure you're not in a risk tolerance you just don't intend to be, and tax loss harvesting at the end of the year.
Yeah.
Both of those require some paying attention and kind of getting into the weeds a little bit. So if you're at the end of the year and you're just looking for a little help, sometimes reaching out on those two things can be real helpful for
Yeah.
these folks doing it themselves. If you're paying someone to do this, both of those things should be being done for you. And if they are not, please go back to the other episode that we had about finding a financial advisor and finding one that works for you, because I think that's important.
Yeah, and just, it's a good way to lower your tax liability throughout time. It can actually increase your rate of return over time if it's done properly.
Right.
Because you're not losing a portion of that rate of return to taxes.
Right.
So,
I mean, in the ideal world, your account is going up, but on paper, it looks like we stay flat.
Yeah.
And that's kind of how your accountant's going to like it. That's how you're going to like it.
Exactly. And I think one of the other interesting things you can do with gain harvesting that's kind of similar to a Roth conversion, but whereas the money is in a taxable account where you can't convert it, you can do is take, if you have years of low income, you can take your gains and stay below capital gains brackets, because the way capital gains tax brackets work is the first bracket starts at 0%.
Yeah.
So, if you're underneath that bracket threshold because you've got minimal income or no income and you've got large capital gains, you could be selling those positions at the end of this year or earlier throughout the year and not paying 0% capital gains taxes on it, still being taxed just at 0%.
And this is powerful for folks in retirement who just have real low income,
just in general,
who may have some opportunities out there to be taken advantage of. Certainly, one of those. Again, I'll always harp on this: talking with a financial advisor and talking to your accountant. Right? Where am I on this tax bracket, and kind of what are my opportunities to make? I got to tell you, a 0% tax bracket is my favorite tax bracket. So using that would be helpful.
Yeah, definitely. I think really just kind of the last thing to wrap up the whole end of year tax planning is, once the end of the year comes, you're going to start getting a lot of forms in the mail. You're going to definitely want to save those and be able to bring them to your tax professional, or if you're a do-it-yourselfer, make sure you got everything on file. So when you're going through TurboTax or H&R Block or whatever service you use, you got it easy, and it's not a pain in the butt to say, oh man, I got to do taxes this year. Just the better organized, the better it is for your tax professional, and the better it is for yourself. So.
Just organization ends up always being the best way to do it. But awesome.
If you don't think that you might, if you're wondering if you might need something that comes in the mail, just keep it.
Yes. Easier to shred things than to dive back to the trash and find it. So that kind of wraps it up. I want to thank everyone for listening to this. Again, check us out on YouTube. Subscribe, like us, tell friends, comment, review. We love it all. We have our stock game that we played. It looks like, Visa's up 9%. It looks like your fringe pot stock was up 9%.
Yeah. I went from 11 cents to 12 cents.
Yeah, big money. So I guess we'll call this week a wash.
So that keeps me on the top of the leaderboard after the last episode.
I still owe you lunch.
I gotta pick a new one though.
We do need to pick new ones. I am looking at. Jeez, why don't you go first this time?
All right, good, because I just thought of what I'm gonna pick. I'm gonna pick Monster Beverage Company. The energy drinks, sport drinks.
Yeah.
I don't know how they're doing. I haven't even looked at the graph, but they're one that came to mind. Been fairly optimistic about them in the past, but that was a long time ago.
Sure.
So, multiple years. But we'll see what they can do in 2 weeks and see if I can pull out another win.
Okay. I'm going to go with. Oh boy.
You were going to pick Monster Energy drinks, right?
No, it's late in the day here. I think I need a Monster Energy drink. I'm going to go.
Should get them as a sponsor.
Anyone from Monster listening? Why don't we go with? Geez, this one has bounced back to its highs, but I'm gonna ride it a little bit longer. I'm gonna go with Disney.
Okay.
Something about all the vaccine news in the air that's coming on TV is anything that gets people back into roller coasters. I think would be good, but they also have the Disney Plus, which it seems to. I have kids, and I know that I would pay anything for that, so I'm sure that they know that as well.
Yeah. Hey, nothing says get on a roller coaster like getting stabbed with a needle.
All right. And
Yeah,
on
we're gonna
that
end it
note,
there.
The foregoing content reflects the opinions of Penobscot Financial Advisors and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Thank you.